What's going on, guys? So today, what I'm going to be teaching in the course that I'm teaching out this week is really starting to break down the understanding of how do we collect the different inputs that we need to analyze a real estate deal. Now, when we look at a real estate deal, there's really four different phases, if you will. You have without financing before tax. All right, that basically says, hey, look, I'm paying all cash, and we're just going to look at the cash flows with no tax really being added in there. Then we have without financing after tax. So now it's saying, all right, well, look, we still don't have a loan. We're going to go out there and pay all cash, but now let's see how this tax actually impacts us and how it affects our return on our investment. Then the next phase is with financing before tax. So now we throw in a loan. And we want to see just overall, how's the cash flow going to play out? How does this investment play out for us? And then finally, the last phase is with financing after tax, which is often the most realistic approach that we take to real estate in general. And now this is saying, hey, look, I took out a loan. I got this property. It's great, cash on cash return, and so forth and so on. All of this is good. But how is it actually going to affect me with my taxes? Now, this is a unique one. The reason why it's so important is because when we look, especially for the real estate professionals, right? But also for you. But when we're talking to investors, right? And I'm taking most of you guys are probably investors. Maybe some are real estate professionals. When we're communicating to the investor, what the investor really needs to know is, hey, look, which of these options is probably a better deal for me? And oftentimes we only look at what happens before taxes. We say, all right, your cash flow is going to be this. You put this much money in, so therefore your return is going to be X. Now, in reality, though, once we make all that money, we still got to pay the tax man. And everybody's tax bracket is slightly unique. Some may be in a higher tax bracket because they just earn more money across their entire portfolio. And some may be in a lower tax bracket. And if, in fact, when you start to look at how the taxes are calculated, depending on your situation, your tax bracket, some other assets you might have, all of those are going to affect you differently. And so as we look at these things, ultimately, at the end of the day, what we're trying to identify is something called an effective tax rate. Now, what an effective tax rate is, it basically says, hey, look, this is our tax bracket, but because of our assets, our investments, it has either increased or decreased our overall tax rate, our effective tax rate, the mix of kind of where our tax bracket was and how this asset helps us. And ideally, real estate should be saving us taxes or effectively decreasing our effective tax rate. If that's the name of the game, I mean, the wealthy go out there and buy real estate to help them pay less in taxes. Most of the smaller entrepreneurs, most of the people that started on the grassroots investing in real estate were doing so because we wanted to create a different lifestyle. We wanted to create wealth. We wanted to create passive income. And so although I think it's a great strategy, we have to understand that it takes time. And by us looking at purely how to make more money in real estate, we forgot, or most of the time there's a lot of misunderstanding of really what is the essence of real estate, right? It's meant for the tax advantage. So again, there's a ton of people who will do, let's say, fix and flipping. And they'll do fix and flipping with the intent to buy rentals. Now, buying and holding the rentals is where the real benefit comes from. The flipping is active. That generates wealth, yes, but it does nothing to help your taxable income. Matter of fact, you have a ton of capital gains now that you're looking to offset. So your taxes are typically significantly higher if you were just solely flipping or wholesaling. But owning the property, that's where we really get to see what that effective tax rate does. So if you guys want to learn more about this concept, then absolutely just let me know. Put it in the comments below, and we'll make sure to make more content about this. And any specific questions you have, the better, so we can address them directly. But as always, thanks for watching, and we'll see you in the next video.